In this video, I'm going to go over payroll journal entries. Now, most of the time, if you're using the same payroll processing service and accounting program, your entries will be done automatically. However, if you use a separate system to process your payroll, you'll need to figure out a way to get that information into your accounting program. Some processing services sync. For example, Gusto syncs with QuickBooks. But not all systems are going to sync, so I want to go over the payroll journal entries in detail. I did make a video related to this several months back, and I had an example, and I'm going to use that same example in this video, but I'm going to spend a lot more time going over the entries, different situations that I may not have addressed in that video, and I'm going to go in a little more detail about debits and credits and things like that. And this is the example that I went over. I set up this sample payroll preview. And then what I did in that video is I created some journal entries that go along with that. But what I did with this spreadsheet that is available on my website, and I am going to put this updated one on there today, but basically in my updated spreadsheet, I actually put some explanations over here on the right. And then I also created an alternative, because if your payroll is being processed by a service such as Gusto, they're going to deduct the net pay of your employees from your checking account on the day of payroll, or the day before actually. But they're also going to go ahead and deduct the taxes, because that payroll processing service in particular will deal with your taxes for you. It will submit your federal income taxes and your state income taxes and things like that. So the deductions happen at the same time. If everything is happening at the same time, then a shortcut would be to just skip over these payable accounts and then the reversal of those payable accounts. So that alternative is on my second page. And then what I'm going to do is go over these journal entries in Wave apps. But a journal entry can be input into pretty much any accounting program, and you can add journal entries right here. But before we get into the journal entries, I want to go over some foundational accounting knowledge that would be helpful for you to know if you are doing these entries. First, we're going to go over debits and credits. These represent increases and decreases to accounts. A debit is simply an entry on the left side, and a credit is simply an entry on the right side. And when they say left side and right side, if you see that in a textbook or on a website, what that means is the left side of a T account and the right side of the T account. So if you were to do an accounting class at a college or using a textbook, you would probably learn T accounts. It's basically just like a ledger for each account, and you put debits and credits on either side and then get the ending balance at the bottom. So I'm not going to go into that much detail, but just know that debits and credits represent increases and decreases to accounts. And then every transaction is going to have at least one debit and at least one credit, and your total debits must equal your total credits in the end. So every entry that you make, your debits and credits need to equal. And that's just so things are in balance. Now, whether something is an increase on the debit side or a decrease on the debit side and vice versa, just depends on the type of account. So I have this little chart. Assets have the increase side on the debit side, decrease side on the credit side. Liabilities, equity, and revenue are the opposite. The increase side is on the credit side, decrease side is on the debit side. And then expenses are going to have the same rule as assets. Increases are on the debit side, decreases are on the credit side. So this is just foundational accounting knowledge. If you own your own business or you're in accounting, if you're in accounting, you probably already know these rules. But if you own your own business, you should at least have some baseline knowledge if you're going to be doing your own accounting. And then journal entries are going to be what we're going to do today. You use journal entries to actually record transactions in your accounting program. And a journal is just a chronological record of transactions. Journal entries are created behind the scenes. So when you're writing a check in QuickBooks, QuickBooks is doing the entries behind the scenes without you really seeing them. Same thing when you record deposits, you create an invoice, all those things create entries. And the debits and credits are being posted in that accounting system behind the scenes. And again, you always have to have at least one debit. And I made a mistake on my slide. I need to change that. At least one debit and at least one credit, with total debits and credits being equal. And I'm gonna fix that. Okay, I fixed that. So I'm just gonna show you an example of a journal entry. This is what it would look like in an accounting textbook format. But basically you would have the date over here on the left. You usually put debits first and then credits are underneath and indented, just because in the olden days when this was all done by hand, written out in these journal notebooks, it was easier visually to see the difference between the debit and then the credit being indented. But basically you would have your debit account. So if you're writing a check to pay advertising expense, that would be a debit to add to your advertising expenses, and a credit to your checking account, which is an asset. So you're subtracting from the checking account by writing a check. And then underneath, usually in italics, it's going to show some sort of explanation. And what I used to say when I used to teach accounting is that in real life, this would be specific with check numbers, customer names, things like that. But when you do it in a textbook in an accounting class at a college or high school, it's going to be more generalized. So now let's get into actual payroll entries, payroll journal entries. So I'm going to go over some payroll related accounts that are common. So first you're going to have your wages, salary expense. These would be your gross wages. And remember, expense accounts, we do the increase side on the debit side and the decrease side on the credit side. So when you're adding two expenses, you are doing debits. And this gets confusing because a lot of people think of expenses as subtracting from your business, but it's going to subtract on the profit and loss statement. But at this point, when you are entering expenses, you are adding to your expenses. So you're going to see salaries, wages expense, payroll tax expense. This would be the employer payroll taxes, not withholdings from employees. 401k matching, if the employer matches any 401k or retirement plan contributions of the employees, that would be an expense of the business. Now, sometimes companies will do reimbursements through their payroll system. So they might reimburse their employees for things like phone. If the employee uses their home office, the company might reimburse them for things like internet. Or if the employee buys some office supplies or something for the business, the company may reimburse them for that. So that is going to be an expense of the business. And we're going to be adding to those expenses in our entries with a debit. And then of course bonuses and commissions, that would be an expense treated similar to a salary. And then insurance expense. This gets a little tricky because if the employee is paying expenses, for example, if the employee pays a portion of their medical insurance, that actually reduces the expense of the business because the employee is paying part of that expense. So these are going to be decreases to the expenses. Okay, moving on. Let's go to the next one, asset accounts. The main asset account you're going to deal with payroll entries would be your checking accounts. Some companies have a separate payroll checking account. Some companies use their operating account. It varies. But either way, whatever checking account they use to pay payroll, there is going to be entries related to that. And For an asset, we're going to be decreasing the checking account most of the time, so that's going to be a credit. And then we're going to have a lot of liability payable accounts with payroll. There's usually FICA taxes payable, federal income taxes payable, state income taxes payable. So these are withholdings. The income taxes are employee withholdings. The employee is going to be paying those taxes, and it's deducted from their paycheck and then sent to the government agency. FICA taxes, that is a matched tax. So the employee pays a portion of it and the employer pays a portion of it. And then unemployment taxes in most states in the United States, that is an employer tax. It is not an employee tax, but I believe there's a few states that the employee pays some unemployment taxes, and I'm not 100% sure which states those are. I used to talk about this when I used to teach payroll at a college, but it's been a long time since I've done that, so I'm just not super familiar. But if you're in a state that the employee pays it, you'll know. And then 401k or retirement plan payable, that's just, most of the time that's done separately from the payroll system. It just depends on what payroll system you're using. But basically, you're going to hold money in the payable account and then send it to the 401k administrator. And then there might be other taxes payable. For liabilities, you are adding to debt with a credit, adding to the debt of the business with a credit, subtracting from the debt of the business with a debit. I hope I said that right, and I didn't mix up my debits and credits, but it is on the screen. Add to debt with credit, subtract from debt with a debit. And then for liability payable accounts, I just want to mention also that these accounts should zero out when the taxes are paid. So you're crediting the account when something is owed, and you are debiting the account when it's paid, and the net effect should be zero. Then we're going to have some miscellaneous accounts that I want to talk about specifically, just to make sure you understand how to deal with it. So for health, disability, life insurance, sometimes the employee pays a portion of this, and this is going to be a reduction in the company's expense. So if the company pays $10,000 a month in medical insurance for employees, but they deduct some of that cost from the employees pay like 10% of it, then the employer is really only paying 90% of it. So if the employee pays part of that, it just gets treated as a reduction in expense. You can create a liability account and adjust that monthly. If you're doing accrual accounting, then you'd be more likely to do that. If you're using cash accounting, you might be more likely to just deduct it from the expense account. I tend to just deduct it from the expense account because it's easier and it's monthly anyway, and a lot of the companies I work for are cash basis. So I don't want to say whether there's a right or wrong way to do this. If you're not sure, you could always ask your tax preparer which way is the way to go. And then owner or partner draws. Sometimes this is done through a payroll service. If the owner is maybe a sole proprietor or a partner, or they're a single member LLC or something like that where they do draws and it's not taxed at that point, then you would just post that to your equity account or guaranteed payments. The only time you would do salary expense is if it's a W-2 employee. If that owner is treated as a W-2 employee, then it would be salary expense, but otherwise it's going to be equity. Every once in a while, I'll have a CPA tell me that they want the partner or owner draws set up as a guaranteed payments expense account, and I will do that if someone tells me to do it because they're doing that company's taxes. I actually don't see that very often, but I do see it. So sometimes you will run into that, and it just varies by, like I said, if the tax accountant tells me to do that, then I will, but otherwise I just assume that a draw is equity unless it's a W-2 employee. This is a case-by-case basis. And then sometimes you'll also have local taxes. that are specific to the local area. Whether it's treated as a liability or expense or both is just going to depend on the situation. But if it's just simply you're deducting it from the employee's paycheck and then you're going to send it to the government agency, then you would probably treat that more like a liability. However, if it's going to be an expense of the business, like the business has to pay it, kind of like unemployment tax, then that's going to be an expense and a liability because it's an expense of the business. And then you would also treat it as a liability where you set up the payable account, just like the federal income tax is payable, and pay it out. Garnishments are typically treated as a liability. It really has nothing to do with the company. They're just deducting money from the employee's paycheck, and then it gets sent to whatever agency is doing the garnishment. Now, tips are usually treated as a liability, but it's going to be a little bit different than the liability for taxes, because when the money's collected from the customer, at this point, it's owed to the employees right here. Whoops. But then when it's paid to employees via the paycheck or cashed out at the end of the day or whatever the situation is, then it's going to be a debit to the tips liability account. It's a little bit different because you owe it at the point of the customer paying, not at the point of payroll. And then some companies have health savings accounts, flexible savings accounts, and things like that. I've seen so many different scenarios with this that it's going to be really hard to talk about it in a video. These accounts are going to be really above the scope of this video. And then there will be payroll service fees, payroll software fees. Those are just expenses of the business. Workers' compensation insurance, that's typically an expense paid by the employer. Typically, that is just an expense of the business. And then employer paid health insurance. Sometimes there are payroll processing services that also handle the health insurance, and it's all done through one company. If that is the case and the health insurance is paid through the payroll service, then they're going to probably deduct the fees for that when they process payroll, and that would be treated as an employer expense. So as you can see, there's a lot of different aspects of payroll journal entries. A lot of different situations can come up, and I'm going to try to show you some examples with several different situations so that hopefully you can form your own payroll journal entry. But just a tip, if you are not sure what you're doing, if you're a bookkeeper, you're working for a new company, and you're not 100% sure if you are doing it correctly, my suggestion would be to look at what the previous accountant did if it's a company that was in place before, and formulate your payroll journal entry from there, just if nothing else to be consistent. First, we're going to go through this example like I said at the beginning of the video. Basically, you've got gross wages here. There is one reimbursement for some office supplies. These are the employee tax withholdings, the 401k plan deductions, and then some of the employees are also paying a portion of their medical insurance and disability insurance. The employer contributes to the retirement plans, and then the employer also has to pay some taxes, some employer payroll taxes, which are FICA taxes, which is Social Security and Medicare, unemployment, federal unemployment, and state unemployment. And then a couple of them don't have unemployment taxes at all. It's just this employee. That's just because usually it's a set dollar amount of wages that those taxes have to be paid on. And then once the employer reaches that threshold, then after that, they don't have to pay the unemployment taxes on that particular employee for the rest of the year. Now let's look at the journal entry. What I did was took my spreadsheet and I added some notes here on where the numbers are coming from. So this is going to be gross pay of all the employees. The reimbursements to employees are recorded in an expense account. Now, some companies have a separate reimbursements expense account, but I have dealt with companies that do this, and at the end of the year, the tax accountant always wants to know what the reimbursements consisted of. For me, it's easier to just go ahead and post it to the account that is actually related to the expense. So if it was office supplies, record it to office supplies expense. If it was telephone, record it to telephone expense, and so on. That's just how I like to do it. The employer payroll taxes, that would be the unemployment taxes and the FICA matching, that would go under payroll tax expense. The medical premiums and disability insurance premiums paid by employees, I just did those as credits to subtract from the business's expense accounts, because this is going to reduce the employer's expense. And then I set up payable accounts for all of the taxes, and I did separate payroll accounts. You could lump all of these into one payroll liabilities account, but I recommend having individual accounts if you pay them individually, so you can keep track of whether you've paid the federal income taxes, whether you've paid the FICA taxes, and so on. Actually, FICA taxes and federal income taxes could be combined, since they're going to the same place. They're going to the IRS. But I'm assuming you're using a payroll processing service to pay them all. So in my alternative entry, I skipped all of those payables. There are no tax payable accounts. I just directly deducted the payroll checking account. And then for the 401k payable, this would be the employee retirement plan contributions that will be paid at a later point. They are usually not paid with the payroll processing service. I'm assuming here that the company is paying a separate retirement plan administrator. And then I called it payroll checking account because some companies like to use a separate payroll checking account, but it could just be your checking account. It doesn't have to be a payroll checking account. I just wanted to point that out. And then here would be the employer. If the employer matches the retirement plan contributions of the employees, sometimes there's a matching plan like 3% of wages, up to 3% of wages, or up to 4% of wages, or something similar. If the employer matches any of it, that would be a debit to an expense account. I called it profit sharing, and it could just be called retirement plan contribution expense or matching expense or something like that. What you call it is gonna vary by company. And then as those withholding taxes and FICA taxes are paid, as they're paid, you would want to reverse the payable or do the opposite. So when it's owed, like for example, federal income taxes, when it's owed, you do a credit, but when you're paying it off, you do a debit, which is the opposite. So the credit and the debit subtract from each other and zero each other out. And that would be for all the taxes. If you pay them individually, you're probably going to have separate entries. So you would probably have state income taxes payable for $270, checking account for $270, or you would do them individually. And then the 401k payable, once the money is sent to the 401k administrator, then you would debit the payable account. So up here, when the money was withheld and the money was matched by the employer, those are credits to the payable account. And then when it is sent to the 401k plan, it would be the opposite. It would be a debit. So these two credits are going to subtract or offset the debit. Okay, so like I said, what I did is I took out all of the payables and did this example as a shortcut, but I also wanted to show you this in the program. So let me show you that. So I did 3 journal entries in Wave Apps. This is the first one. This is what it might look like. Basically exactly what I did. I set up all these accounts in the chart of accounts. Payroll, office supplies, employer taxes, those are all expense categories. Insurance and disability are expense categories. 401k-able is a liability account. And then of course your checking accounts are asset accounts. And I can actually add a column for which category they go under on my spreadsheet before I upload it for you guys. Okay, and then I also did the journal entry for the employer 401k contribution match. And then I did a journal entry when they paid the 401k contribution. Okay, so let's look at a couple of other situations that were in the PowerPoint presentation. Let's look at what would happen if an employee had a garnishment of $300. That's going to be $300 less net pay. And then you would have a garnishments payable account for that $300 that was going to go to that agency, whatever it was, a tax agency, child support agency, whatever the garnishment was for. So that's how it would look if you had a garnishment. You would just have another payable and the net pay would be less. Let's look at the reports real quick so we can see what we have at this point. So I just went to reports, and first we're going to look at the balance sheet. So right now, if I were to look at the checking account, I should see deductions of payments being made for things like the payroll taxes, 401k contributions, things like that. I should see any payables related, anything that hasn't been paid yet. So the garnishments payable, I have not posted a payment to pay that yet. Right now it shows that $300 needs to be paid or sent in for that garnishment. Let's look at the profit and loss also. So I can see the 401k contributions, that would be the employer match. The employer's payroll taxes would be here. The gross pay would be under salaries and wages. And then I also show insurance, medical, and disability. Let me just click on these so I can show you what that looks like. So you can see that they made a payment to pay insurance for the company for all the employees, and then any deductions offset what the employer paid. So the employer paid $2,000, but minus the employee deductions and their contributions towards it, that means the expenses of the business was reduced to $1,695. And then let's also look at the disability insurance. It's going to be a similar concept. The employer paid $120, but then the amount the employees paid towards that is subtracted from the employer's expenses. Now let's go back and show a payment to pay the garnishment. They were paying the garnishment. It would be a debit. When you pay a debt, it's a debit to the debt account. And then we're subtracting it from checking, so it is going to be a credit from checking. Okay, so I'm going to save this and we're going to go look at how that looks on the balance sheet. Okay, so if I go to checking, that just shows up as any other payment. It subtracts from checking. The amount went down. And then notice that you don't see the garnishments liability account anymore because it was paid, or it's no longer money owed. Let's do another example. Let me go back to that original payroll entry. Let's say you also pay workers' comp insurance through the payroll processing service. And this is not an employee deduction, but it is an employer expense. But it gets paid along with all the other taxes and things like that. So in that case, I would probably just add a line with a debit to the workers' comp insurance account, expense account, because this is typically an expense of the business. And then it's probably going to be deducted as part of your tax withholdings payment. So that's what your entry might look like with that. It would be a debit to expense, and it's going to add to the checking deduction. So that can happen as well. Otherwise, I'm going to stop the video so it doesn't get too long. If you have any questions, feel free to ask me in the comments below, and otherwise, thank you for watching.